Let's move on to some of those common trading mistakes. So firstly, as we've just gone over, not understanding the trading conditions and the zone of the market. If you are in a positive zone and you're trying to sell the market, you're really just banging your head against a brick wall. You're going in the wrong direction. It's overused, but the trend is your friend. So knowing when to sell the market in perhaps a negative zone, or knowing that if it really breaks one of those key levels, like I gave you an example just now, if it broke that 12,730, it's really negative and the market can move a lot lower, or you wait for the market to break that level and potentially get some kind of retrace. So just understanding the conditions of the market. The need to trade every day. Now, this does depend on your own particular strategy, but for myself, I normally have 1 to 2 very high probable trades every week. This week, I did not put an official trade out at all, and it's okay. We don't need to trade every day. We are like hunters. We are really like a sniper, just looking to target the right trade when the right conditions and come along, and we'll take the trade. So really just getting into the habit of just being patient for the right trades to come along, and then they come along like buses. We'll have 3-4 trades in a row. This week, the market conditions did not suit trading, and we stayed safe in the market, and I guarantee you a number of people will have been taken out of the market this week. We'll talk about the advisor service a little bit later, but since we've been running the advisor service, a 70% overall hit rate on the trades, and the DAX trades that we've been taking are sitting at 100%. We've had no losses at all. So of course we will get a loss at some point, but it really is waiting patiently for those trades. It can be frustrating. Certainly it's very counterintuitive. It's almost like getting ready for work, getting on the train, going to the office, sitting down at your desk, grabbing your coffee, opening your computer. There is nothing to do for the day. So you sit there for 5-10 minutes and you go home. But that is what trading is, and that's what we did many times this week. Looked at the market, there's really nothing to trade. We put some alerts in for ourselves to let us know if certain areas will trigger us into a potential trade. Otherwise, we leave the market alone for ideal conditions to set up. A very, very obvious one is not using stops, not using stop losses in the market, not having a predefined target of where you're going to be targeting in the market and a predefined stop. If you do not have a predefined stop, like that 600-point move in the DAX, which happened very, very quickly, you can very quickly get into some very hot water, or potentially, sadly, blow up your account. So making sure you've got a predefined risk that we typically risk about 1% on our trade. The stop loss could be different. It could be 30 points, it could be 100 points. It doesn't matter. But we know, as we showed you earlier, that if the market's going to go through this level, again, using the example of the DAX, if it went through 12,730, you are wrong in the trade. So if you're long in the market, you've bought the market, you want your stops below that level, and you want to get your risk calculated correctly, that you're only risking 1% a trade. So that really does lead me on to the poor risk and leverage management. Often, sadly, we see that people over leverage, perhaps don't have a stop, and maybe risking up to 5% of their account on a trade. They don't have a stop loss, and the market moves 600 points against them, and suddenly their dreams of trading have quickly disappeared. So don't fall into that. Calculate your risk, calculate your leverage correctly, that you're only risking 1 to 2% a trade. It's fine to risk up to probably 4% a trade if you have a smaller account. As I say, typically we risk 1% a trade on our account, but we have a larger account. So these are perhaps obvious things to have: stops, risk management, and leverage correct. But unfortunately, the old common sense is not always common practice. So make sure that you really get these in place. Perhaps have a checklist before you place any trades, that you've calculated how much of a dollar value is your risk, what's your 1%. So say for example on a $10,000 account, your risk would be $100. So if you've got a stop of 10 points, then you're going to be $10 a point on that trade. So you're not going to lose more than you have already predefined. And that goes for the wins as well, that sometimes people over leverage incorrectly, or they don't leverage the same amount on every trade. You've got to put the same amount on every single trade, because we don't know which trades are going to be the winners and losers. But what we do know, probability, is that we're 7 trades out of 10 we are going to win. So we get our leverage the same, risk the same every time, and make sure you get a stop loss in place.